Well, today you are in for an absolute treat. I have with me today Cortland Brown, and he and I actually know each other from local to Utah, and we were both wholesaling simultaneously at the same time and competing for deals together. And I actually snatched one from him. He's still bitter about it.
Yes, so bitter.
Clearly. But then we decided we should start working together from then on. And so he and I have been part of a wholesale team for over a year now. We do a lot of creative finance in Utah. And because you guys are listening to this channel, you're probably hearing some buzzwords about sub two and creative finance and seller finance and private money lending and all these things. So we're going to just tackle a couple of questions today about what is creative finance and go a little bit deeper. And Cortland's going to answer some of those questions for us so that you guys are clear and maybe you can do a deal with us going forward. Does that sound good,
Yes, come do
Cortland?
a deal with us. Yes.
Perfect, perfect. Anything else you want to add before I start peppering you with questions?
Yes, very bitter about the deal that she stole from me that was like literally a minute from my house. And
Sorry.
actually, you know what's funny? We found this out after the fact that Liz, who's also on this channel a lot, uh, owns a home that I also was trying to get subject to that they snatched from me as well. That one, a little less snatching because it was more of like a, hey, I think I could possibly get it. The other one, he had a freaking contract and then who knows? Anyway, it's all good. I'm just kidding.
Oops.
Clearly, we're partners. We own properties together now, so we must have gotten over it.
Yeah, no, and it's fun because in the community we all kind of do some deals together, and it's been awesome getting to know you and working with you. So I'm excited for what we're going to share with people today about creative finance. So without any further ado, give me a broad explanation of what is creative finance in real estate.
Yeah, I mean, it's super simple, actually. It's just something that isn't bank financing. It's not going to the bank and saying, hey, I want a mortgage. It's doing something different than that. It can mean a bunch of different things, but it's just being creative with how you figure it out. So I don't know. Even going to the bank could be creative in my mind. Maybe how you do it. Like, hey, I'm going to get an FHA loan, which is a normal mortgage package that a lot of people have, but I'm going to go buy a fourplex with it. And I'm going to use that to rent those rooms out and I live for free. So that's a creative finance method through a bank. It could be seller financing. It could be terms like subject to, which I know we'll get into. But there's a whole bunch of things. I would just say it's something different than just going to the bank and getting a loan.
Okay, so give me a couple of examples of how creative financing can be different from going to the bank.
Sure. So I mentioned seller financing. So seller financing is where you go to a seller who owns their home outright and they're the bank. They finance it to you. And your terms can be whatever you want. I mean, your terms could be, hey, I'm gonna, pay $1,000 a month and a lollipop on every third Wednesday. I joke obviously, but that's what it is. And the cool part is when it's with just you and an owner and there's nothing else there, you guys can be as creative or make it as big a win for both parties as possible. Um, Another example would be subject to, which is it's very similar to what I just described, other than there's maybe an underlying mortgage. So you're taking over someone's mortgage, you're seller financing it from them, but you're not involving the bank, even though there is a bank transaction there. And so basically, you're taking over that mortgage. You're going to pay that mortgage for the seller, and now you own the home. So that's one way. Those are two examples. Another might be, someone who buys a fix and flip property and they use hard money. They don't go to a bank. They go to a lender of sorts for money to do that rehab, and they have a very short window that they got to get it done, and they have to either refinance out of it or sell the house and move on another way. So those are like three, I think, pretty good examples of something creative.
Definitely. So, who can really benefit from creative finance and maybe who benefits the most? Is it buyers? Is it sellers? Is it investors? Is it regular home buyers who want to like live there? Who's the main target?
Yeah. Honestly, I think the coolest part of creative finance and the thing that actually drew me to it a lot is that I think everyone can walk away from the transaction happy. I think that it can benefit a seller in a lot of ways. Oftentimes, sellers can get more money than they would traditionally get. They might be able to not have an agent where they're paying agent fees as well. So they might be able to get more money in their pocket. A buyer can get terms or a price that makes sense, or something that cash flows where it may not if they would have gone traditional route. Um, and investors, I mean, this really works for investors as well, because maybe banks have very strict rules on, hey, this person owns 3 homes. Now their debt to income's funky. You could be worth a lot of money, and just because your debt to income's off or your credit's off, it's not going to work. Whereas with creative, that investor now can go buy in more homes. I know with me and some of my partners, we own a couple homes, but if we were to go to the bank right now to get a loan, they wouldn't even show up as us owning them, because they're owned in an LLC, or their own, we're taking over someone else's mortgage. So there's a whole bunch of different things, but I think everyone can walk away a win-win. My friend has this saying that I love so much, is he says with creative finance, he doesn't have to be a shark when it comes to real estate.
I like that.
Everyone can walk away happy.
I like that. Yeah, oh man, that's really good because it's so
Yeah.
true, right? It's a
Yeah.
win-win for everybody potentially, as long as the deal's set up correctly. Dang, I really like that. You have a
Yeah.
smart friend.
Yeah. Well, he owns a lot of them, so he better have figured out something.
Yeah, no, definitely. So why, I mean, goodness, you're talking about somebody potentially taking over a mortgage, and that's what you said sub to. So why would a seller ever agree to let you take over their mortgage?
That's such a good question, and it's very nuanced. And the reason I'll say this nuance is when you take over someone's mortgage, there could be so many reasons. Um, One is they've already moved on, they have another home, they just want to sell it, and they're happy to give you terms because maybe it benefits them from a tax perspective or an accounting perspective. Like, it's really hard to know everyone's circumstance, and every deal is individual. I mean, you and I have done a lot of deals together, and every single one's different. A seller might do it because maybe they bought their house when the market was at a peak and now it's lower. And in order to sell their house, they're actually going to have to pay money to sell their house traditionally, pay agent fees, pay whatever. I have a video I'm actually going to make separate of this, but I have a video where we had an agent that we went to literally the first time I emailed her was a year ago in 2 days. So almost a full year ago. We gave her an offer where the seller would walk away with like a grand or 2 grand. And they didn't want to do creative, or she didn't, I don't know who it was, the agent or the seller, I don't know, but they didn't want to do it. They are closing on that. They closed on the property today with a buyer who assumed that loan from them. I did a little math. Their monthly payment was $2,700 a month. So they've lost over $30,000, or not quite $30,000, I think, in maybe 32 in the last year of paying mortgage payments.
Wow.
They had to pay the agent out of their pocket. They had to pay the buying agent out of their pocket as well. All in, they're probably at a loss of 50 or 60 grand in the last year on this house. That had they done the creative deal last August, they probably would have walked away with 2 or 3 grand and been able to just move on. They've already moved. They've already done all the things. So they're a perfect example of a situation where creative would have saved them 50K. And that's 50K. That's real money. That's not like 50K of equity or potential money. That is 50K out of their pocket, gone in the last 12 months.
Wow. I mean, I think that gives you a really good example of why someone should have wanted to do creative.
Yeah, yeah, right. It didn't work. For whatever reason, they didn't want to do it, and that's fine. But I think, that's just one example. I've seen people, a situation where they're divorced and they just got to get rid of the house fast, and we had investors that can do it. So there really is a lot of reasons someone would do it, and we could literally make a list all day long. Like, this is a reason. This is a reason. They moved. A lot of VAs. This is another great one. We see a lot of VA veterans or active military. They get transferred to a new base. They bought a house, and a year later, they're kicked across the country to a new base, and they don't know what to do with that house. Maybe they could rent it. Maybe it won't rent. They don't want to be a landlord from, 6 states away, and they just want to get out of that house and not lose money. And with VAs, they don't put any money down on their properties. And so odds are if they've only owned it for a year or two, they're probably a little bit underwater when they try to sell.
Yeah, and I think most people forget, let's say you buy a house for $500,000 and you don't put any money down because you have an awesome VA loan. And then let's say the next month you have to sell it. And let's say you're able to sell it for 500,000. You're like, yes, okay. I mean, man, I bought it for 500. I'm selling for 500. I'm like, not out any money. False. You're going to have to pay your buyer's agent for the people who are, buying your home. You're going to have to pay your seller's agent to list it. You're going to have to pay closing costs. You might have to pay concessions. There may be any other little nuances in there. Somebody might want a rate buy down because it's, the interest rates are crazy right now. And then all of a sudden you're out 50 grand because between all those fees, it's normally around 10% to sell your house, which is just crazy. So even though it was a perfectly fine house and there weren't any issues with it, if you needed to turn around and sell it right away, you would be out 50 grand. So that would be huge potential
Exactly.
opportunity for someone who wants to just sell their house subject to you.
Yeah, no, it's a perfect example. Yep.
Yeah. So is creative finance only for people with bad credit?
No, that's a good question though. We get that a ton. Yeah, no, definitely creative finance is not just for people with bad credit. I know plenty of people doing creative finance who have amazing credit. I think that it can work for someone with bad credit. It's a great opportunity potentially for someone with bad credit. I mean, we do creative deals, we wholesale them, and oftentimes we check their credit or we check to make sure there's someone who can still pay. I think the bigger advantage is for people to be able to buy maybe more homes than going through a bank. Um, Also, probably being able to just move quicker. People want to assume a loan it's going to take 6 months. With creative, if we were to do a subject to transaction, it might only take, I don't know, 15 days, 30 days, and we were into the house.
Yeah. So can you tell me a little bit more about the components of a subject to deal? Like what's an entry fee? What's the PITI? Give me some of those.
Sure. Some keywords here. Yeah, yeah, totally. Keywords. So, yeah, so you oftentimes hear people, investors talk about the entry fee to get into a deal. And what that is that is total money out of pocket for the buyer to buy the property. So that whatever that adds up to be, it's probably a sum of a down payment to the seller, paying the agent if there's an agent involved on either side. It could be buyers or sellers agents. Oftentimes that includes closing costs or an assignment fee. If you were to buy this from a wholesaler, they're going to charge a fee because they found the deal, they put it together, and they're now selling it to you. Um, so all those added together, that's going to be your entry fees. That's just total money out of pocket. And some deals there might be, like if we were to put this on a line item or a spreadsheet, there might be 10 items, and on other deals there might only be 3. It kind of depends on who's involved and what other things are there. So that's going to be your entry fee. Other common terms you might hear in a subject to deal is PITI. That's principal, interest, taxes, and insurance. So that's understanding what a seller is currently paying. With a subject to transaction, we're taking over someone's mortgage. So we need to understand what their PITI is, their principal, interest, taxes, and insurance. Trying to think, amortization, something we hear a lot, but it's how basically how they amortize interest versus principal payments. You can look that up in a mortgage calculator. It's probably the easiest way to do it. But, there are different ways that they can do simple interest or amortized. And it's kind of how it breaks it down. I'm
What
trying to
about a
think what other.
balloon?
Oh, a balloon's another. Yeah. So a balloon would be when it's due. So most people, they get a 30-year mortgage, and at the end of 30 years, they own their house. Well, in creative finance, you might structure something where, hey, I'm getting this really cool deal, but it's only going to last for 10 years. At the end of 10 years, I either have to sell that property to pay that person off, or I have to refinance to get their name off the loan, or what. There's a whole bunch of things, but a balloon is that's when it's due. It could be, in hey, zero money down, but in 5 years we want 20K. There's your balloon. You owe them 20K in 5 years. Balloon, or another term I think that's good for that, is like a due date, essentially, for when it's due. Or oh my gosh, there's a term I'm looking for. I can't think of it right now, but I'm sure I'll think of it.
That's okay. So what's the smallest entry fee you've ever seen on a subject to deal?
Sure, I have seen a zero down deal, but that doesn't mean $0 for an entry fee. So it's zero down, meaning no money's going to the seller, but there still was closing costs. And that one, I think the person ended up just buying themselves. So they literally got a house for closing costs. Most of the time, if you're getting a deal like that from a wholesaler, you're going to pay 10, 20, 30K because they're gonna upcharge it, most wholesalers, but they may not. I actually have a friend who they wholesaled a deal for free because they were just trying to help someone out. And it was literally like someone take over the mortgage. They were just, it wasn't necessarily, it wasn't a situation where like it was a really big win for an investor or a really big win for whatever. And so the only way to make the deal make sense for someone was that it was closing costs. That's it. So, but yeah, I mean, it does exist. I didn't believe it when I first started doing this, but it does exist.
Yeah. So you've mentioned wholesaling a couple of times. Can you tell me what exactly a wholesaler is?
Sure. So a wholesaler is someone who either finds a property for sale and then turns around and sells it to an investor or an end buyer. And when they find it, what they do that's different than a real estate agent. An agent might find it. They make an agreement with you that they're going to sell it for you. They're going to do all these things. A wholesaler comes in and says, hey, here's the price, here's the terms. They put it under contract themselves, and then they turn around and sell that contract. Some people call it flipping paper because you're selling the paper of the contract, or selling paper. Um, and a wholesaler does that. And sometimes wholesalers are referred to like they're the guys that are calling you and say, hey, I want to pay half price for your house. And that could be them. They can also do creative. A lot of the deals we've done together and a lot of deals we do are creative deals where we come in and we structure. It could be on market, it could be off market, meaning that it's listed with an agent, or we just find the seller ourselves. And we structure a deal that we find will make a lot of sense for an investor or a lot of sense for someone who wants to live in the home. And then we turn around and we take that contract and we offer it to somebody else for a fee. Um, and so sometimes it ends up being an investor who's willing to pay a fee because hey, it's a way good structure, or it's a good structure for what they need. Or it might be someone who wants to just live in the home and they're going, hey, look, I can avoid the bank. I can get in there with maybe a better rate. Interest rates much better than what we're getting from banks right now. Any number of things. But basically, that wholesaler finds the deal and then sells it to that person, and they make their money in selling that contract. So they have to have deals that make it a deal for somebody else.
No, that's helpful. So we're talking a lot about investors, but can you use creative finance to buy your own personal house?
Can you?
Hmm.
No, I only said
I've
can you
done
because
it.
Andrea's personal house is a creative finance deal. So yes, 100%. I have two partners right now, Andrea and Weston, who is not here. Both of them, their personal homes right now were bought on creative finance. So it
What?
is 100% doable to buy your own house. Last year, we wholesaled more houses to end buyers than to investors in our area. And I don't, I mean, I think part of it was just kind of the structure of what they were, but that just tells you there's that many people out there that are looking for, people don't want to pay 6.5%, 7%. And I think last year we didn't really have a deal with an interest rate higher than 4.5. And so, yeah, for an end buyer, it's an amazing thing as well.
Yeah, that makes a huge difference when it comes to your own personal house. As everyone listening to this knows, like my own personal house, we got for a 3.49% interest rate when the interest rates in the marketplace were going for 8%. And so
Yeah.
having gone through a bank, our monthly payment probably would have been about double what we currently pay. So our credit scores are great. We've never missed a payment, all of the things, but it's sure nice to save some money on interest.
Yeah. I mean, if nothing else, that's a huge advantage.
Yeah. So help me understand the difference between subject to and a wraparound mortgage.
Sure. Yeah. So subject to is the way I understand it, and hopefully no one corrects. I mean, hope I got it right. But subject to is when you take over someone's payments and you just make the payment for them, and you kind of do it just like that. The problem with that, and I think I've heard you refer to it as a naked whatever, is that it doesn't really protect the seller. It's kind of used interchangeably though. That's the truth. People use it for both. Part of that's due to Pace Morby because subject to is his brand, and it's kind of blanket term for a lot of things actually. But even Pace doesn't really do true subject to. He does what you're referring to as a wrap. And a wraparound mortgage, which is what we actually do. So when I say subject to, that is what I'm referring to. It's where you create another note with the title company. Where the perfect example I had, someone told me this was like if you think of a Chipotle burrito, and then you wrap another tortilla around the burrito, and if you wanted to, you could stuff more stuff in and around that a first burrito and then wrap it, or you could literally wrap a second wrap right around it. So there's different ways you can wrap things. So we can wrap things called a mirror wrap, where it's exactly the same as the underlying mortgage. You can have a wrap where, hey, the underlying mortgage, you said 3.4 was your house. You could go, hey, you know what? I want to sell my house again. I don't need all the cash right now. I have a 3.4% rate. Why don't we turn around and sell our house at a 4.5% rate?
Mhm.
And you'll make a monthly payment of whatever the difference is between that underlying mortgage and that rate. So you'll make a 1%. And then also you're selling your house, right? So there's a bunch of different ways to do a wrap, and I don't want to like overcomplicate it, but essentially you're just wrapping a mortgage within another financial note that you make. Um, and it's recorded at title. It's just like you do with the bank on the underlying. I am obligated to you as the seller to make sure those payments are made to your mortgage company. If there's any money going to you, like that example, I'm obligated to make sure you get that money. And it's protected by a deed of trust, just like it would be with the bank.
That's awesome. So tell me about a lease option or rent to own strategy. Is this similar to what you're talking about with a wrap, or is that different?
Similar, I would say similar but different. So lease to own or rent to own or lease option, they're all very similar. They have slightly different things, maybe little components, but essentially a lot of people will do is they'll buy a house, and then rather than renting it just traditional, like, hey, I'm going to put a tenant in there for a year or 2 years, I'm going to give that tenant the option buy to buy the
Mhm.
house. And people can structure this slightly different, but when I do a lease option, I can what I create an option where I say, hey, I'm going to sell this house to you for a price in 3 years, and you will pay me a small option fee up front for the right to buy it at that price. And then you make monthly payments to me. I'm still paying the mortgage. I still own the home. But with this lease option, you're holding a paper that is also recorded at title that gives you the right to buy my house. At the end of 3 years, if you've followed all the rules that we set up with this lease option, I have to sell you the house. Um, and in doing so, when we do this type of thing, it's a little different than renting too, because you now take a lot more ownership of the house. So
Okay.
as a landlord, I don't have to do the maintenance. I don't have to do the day to day. I don't have to go change a light bulb. My partner right before this, he was running over to change a light bulb at one of our rentals. Right? It's like the headache stuff is a little minimized, but when you do a lease option, um, and again, there's some nuances within those lease options, but that's how it's different than a wrap. If I were to sell it on a wrap, you would own the home, right? I'm selling you the house and you own the home at that point. But in a lease option, you don't own until you exercise that option at the end of 3 years or whatever the term is.
Okay, that's really helpful. So, what types of sellers tend to be open to a creative finance deal? I'm just thinking broad, generic examples.
Type of sellers open to creative finance. Sellers that are in, honestly, probably in a little bit of pain. So it's two sides of the spectrum. It's sellers that are in pain are going to be open to creative finance because they need to get rid of it for whatever reason. And pain is, I hate saying the word pain because I feel like every time you say the word pain, people think you're taking advantage of someone. And that's not what it is. In fact, oftentimes you're relieving their pain. They're in a situation where the mortgage is drowning them, and all they want to do is get rid of this house. And oh, they can't get rid of it because it'll cost them 30 grand to sell their house because of agent fees and other things. So they're in a lot of pain. And, a creative option might pay those agent fees for them, get rid of the mortgage payment for them, and it puts them in a scenario where that pain can be alleviated. I mean, it's not necessarily fun. That's not, for them, but it does alleviate a pain. So, anyways, a motivated seller, someone who's in pain, someone who has moved and's got to get rid of it. They're paying two mortgages, right? And then on the flip side of that, someone who's in a position of power and says, "Hey, look, I could sell my house right now for 500K and just take a chunk of money now, or I can become the bank and make a lot more than 500 by giving it to you at whatever interest rate we agree upon, as long as it makes sense for both of us." So I think both sides of the spectrum are people that are really going to be willing to do creative finance. It can work almost across the board, but those are going to be your people who are most motivated.
No, that's helpful to understand. So, how do you negotiate terms with the sellers on a creative finance deal?
Yeah, negotiating terms with sellers can be all over the map. Yeah, it's literally just having a conversation. I think the biggest thing that I am not necessarily always the best at is understanding what the seller needs. So when negotiating creative finance, I think the most important thing is understanding what their goals are, what they need, and then seeing if we can accommodate that with a creative option. And that's going to be the person that's most likely. If you're throwing out options that have nothing to do with their needs or nothing to do with what's going to benefit them, it's just not, you're never going to come to a place where you're going to make those deals happen. So you really have to figure out, hey, what do you need? Oh, cool. With creative finance, we can actually accomplish that goal and sell your house or and get you your goal, and then also it benefits a buyer in the same way.
Yeah, and I like to think of them as levers, the different pieces that you can pull for a creative finance deal in order to negotiate, right? So you have the down payment, the entry fee, so how much money they're going to get in cash to walk away from the deal. You have the monthly payment and interest rate. You have a balloon. You have all different kinds of things that you can kind of pull and adjust, right? So if let's say they want $100,000 down, well, maybe there's a way that you can give them, just $50 in cash monthly on top of their principal, interest, taxes, and insurance, so that you're doing the bulk of the money up front, and then they're going to have to wait a while to receive the rest, right? Versus instead of doing $10,000 down and $1,000 a month on top of the principal, interest, taxes, and insurance. Or they wanted a balloon in 5 years, so you would prefer 10, so you drop the 100,000 down to 50,000 or something like that, right? There's all
Yeah.
these different levers you can pull and push to make it work for both the seller and the buyer.
Yeah, and some people, like you're saying, some people, one of those levers is likely the most important thing. I need cash today. Okay, well, maybe we can give you a bigger down payment, but I'm going to offer you less total for your house, right? Or the terms have to be really good when it comes to the monthly payment. A strategy we see a lot with creative, I think that's unique to like most other real estate strategies, because most other real estate strategies are like get the cheapest price possible, right? With creative, I know plenty of people who offer, and we've done it. You and I have done this, but is offering above an asking price for the right terms. Hey, look, I'll give you 30, 40, 50K more than you're asking for. But on the flip side, those monthly payments or those other things really have to make sense, because again, obviously we don't want to pay overpriced, but if we can make the interest payments low enough and everything else, then it might work.
So let's talk about interest rates for seller financing deals. What kind of interest rate are you seeing if somebody owns their home outright? What's the interest rate we could expect from a seller finance deal?
Sure. This is an interesting question. If you talk to a lot of real estate agents, they're going to tell you right away that you got to pay market interest rates, like whatever. But what we've seen is that for an investor to be excited, you got to be 5% or lower. That's what it's going to take to be excited. I mean, I think regardless of whether you're an investor or not, what would make you as a buyer, like if you're just thinking of yourself, if I'm buying a house, hey, if I could be under 5%, I'd be excited too, because right now interest rates are 6.5, 7, whatever. We've done a lot of deals 4% and under, whether that's straight seller financing or whatever. But I think the key is not necessarily the interest rate, and maybe it's the market you're buying a house in, maybe it's the monthly payment. So, right, like I think if an investor can make $1,000 a month, but it was a 12% interest rate, why wouldn't they do that if their goal was cash flow, right? The interest rate isn't the only part of the picture, but what I shoot for in all of my deals is 5% or lower.
Absolutely. And it can go as crazy low as 0% interest or principal only payments. So I have done and purchased deals myself where I got a 4% interest rate from a seller who owned their property outright. I also got a 0% interest rate from a seller as part of a hybrid deal, which is partially a subject to or mirror wrap, and then partially a seller finance, and putting them together. So the seller financing portion was a 0% interest rate. So it can really be the sky or the ground are the limits, right, with these interest rates. And it really is about the deal and what makes the most sense for that particular property.
Totally.
So let's talk about paperwork. What kind of paperwork is involved in a creative finance transaction, and how is everybody protected?
Yeah, no, that's a good question too. So paperwork, obviously the same thing as any traditional contract as well. So you have to have a contract initially that goes out to the buyer. Buyers and sellers have to sign it. It's your real estate purchase contract. It's a little different than maybe what your state. Every state has their own version of this. A lot of people have their own version that attorneys have written up or whatever. In a creative transaction, you have one that just explains the terms of your creative deal. So that's going to be the first thing. You have a contract. Um, After that, you're gathering a lot more information because you're taking over someone's mortgage in a lot of these instances. So you got to have mortgage information. You have to understand if there's any debt on the house. That's normal to any transaction. If there's any other debt, we got to understand that. Can we also put that as part of the deal? So solar, for example, we can subject to solar. We can take over those payments on a mirror wrap as well. But there's other things you can't do that with. I'm not going to take over someone's tax liens or things like that. You got to pay those off just like you would a traditional transaction. So the difference is that you're going to have to pay that off to close, and you have to do it out of the down payment because they're not selling their house and going to take those proceeds and pay that off. That has to be part of the down payment to do that, right? So that's the paperwork. To be honest, the best thing you can do is find a really good transaction coordinator because I'm not going to have all the answers on the paperwork. I've done it a bunch of times. I've done some with transactions, some without. And I will tell you, we found a transaction coordinator we really like, Kayla. She was interviewed in your podcast. You guys should go watch it. And Kayla has come in, and it is so nice having her because she is so detail oriented. She'll have all the right paperwork. There's power of attorneys. There are things like that. So that's all the like nitty gritty paperwork. The way we like to structure the deals is we use an all-inclusive deed of trust. So that's our protection thing. That's what gets recorded at title. That's what's created to protect the seller. That's what allows the seller to be able to foreclose if someone doesn't make their payments. There's a lot to it. So again, Kayla, that's your whatever. You go watch her video, but without her, that like she helps make it all better. Because you and I have both done these with and without a transaction coordinator. Here's what I found happens without a transaction coordinator. A month after we close, I'm still answering questions. We're still going back and forth just because I'm not that guy. I wish I was sometimes, but maybe I don't. It's fine. Everyone has their thing. But the point is that there's a lot to it. I mean, we could get into this and we could really go through every single document, but I would say understanding how to do a purchase contract is, I think, super important for pretty much anyone doing this type of stuff. It doesn't have to happen on your first deal. There's plenty of people who can help you and you can figure that out. But understanding what you're doing, reading those contracts yourself is super important. And then finding someone like Kayla who can go through and make sure that your I's are dotted, your T's are crossed, you're not missing anything. Because the last thing you want is, if it's your home or someone else's or you've wholesaled it, it doesn't really matter. The last thing you want is a year from now going, fetch, we messed something up, you know? Because there is more steps than a traditional transaction. This is not just we bought a home, we sold a home. There's some more nuance to it. And so you want to make sure that that's done well and finding the right person. And we went through, I mean, how many TCs have we used last year? Like 6 or 7 different ones?
At least, yeah.
And I would, honestly, all of them were good. We resonated with one that we're using a lot now. That's Kayla. And it's, I feel like that's kind of the story for a lot of people I know in this industry. They kind of figure out, it's the same thing with like who your partners might be or who you're going to buy and sell houses with. Like all of that is the same thing, right? You're kind of finding your tribe, as it were. But yeah, for documents, get a good TC. And then also don't be a moron. Don't be a moron. And all I mean by that is like, understand what you're giving someone. It's really frustrating when you talk to a real estate agent or another wholesaler who sends you a contract and then doesn't actually know how to answer any questions you have about the contract. Super frustrating. Because then it's like, well, you don't even know what you sent me. And then when you start to have this conversation, like, hey, well, we need to get this. Well, why do we need that? Well, we want to be safe. So anyway.
Yeah, and then you clearly haven't explained it correctly to the sellers either, so they don't even know what they're getting into. So it's really important that everyone's upfront. And really, the concept of taking over someone's mortgage is very simple. You just take it over, but the execution is a lot more complicated than that, and would not recommend trying this at home without someone that you're partnering with, whether it's a TC or JVing on the deal or something with someone who's a little bit more experienced.
And I
Completely.
think it's important. The important thing too, where they're not just like this person is letting you use their name
Mhm.
and continue to make payments for them, right? Like you're making their payments for them. Their name stays on the loan. Like the like you should definitely figure out how to at least they understand it, you understand it, and then also, really protect that. I mean, that's like they're giving you a lot of trust, quite frankly. And doing obviously the world's not perfect. These deals are going to go bad sometimes. Things are going to happen, but if you can do as much as you can to like earn that trust, and that's documents are a big part of that.
Absolutely. So, what are the best exit strategies for properties that you buy creatively?
So many. There's just a bunch. So as far as exit strategies, I will go through what we've done, and then I can tell other ones that I'm thinking about. So obviously, you can do your traditional. You can long term rent them because creative. Maybe you're getting a killer interest rate, so long term rent makes sense. This is probably a strategy a lot of people do. It just makes
Mhm.
sense. It's relatively easy. I won't say it's easy, but it's relatively easy. You can do midterm rentals. You can do short term rentals. Another exit strategy might be to sell it on a wrap. So that means, hey,
Mhm.
maybe I buy a house subject to, or I buy it on a mirror wrap, and then I get a 2.5% interest rate. And then I turn around and I relist that house for maybe a little bit more money than I bought it for, and I offer a 5% interest rate. And now I've sold the house again. I don't have to worry about the maintenance. I don't have to worry about any of this stuff. I'm making 2.5% on my money, and I'm kind of a landlord without being a landlord at all. Like I don't have to do any of the stuff. They own the house, and then if they default, I can actually foreclose on them and get the house back. And as long as I'm paying attention to everything going on and making sure that the mortgage is getting paid, then we can do that.
That's awesome. And so, talk to me a little bit more about the due on sale clause for subject to or creative finance deals. What is the due on sale clause, and is there anything you can do about it?
Yeah. So the due on sale clause is something to be aware of for sure. I mean, I think it's something that if you're not aware of, that's not great either. And Andrea, can we pause for a second? Sorry,
Mhm.
is that okay?
So, I've heard about the due on sale clause with a subject to or mirror wrap. What is the due on sale clause, and is there anything you can do about it?
Yes, the answer is yes. So due on sale clause, basically every mortgage or most, I think every mortgage, maybe there's some that don't, but most mortgages have a clause that basically says, hey, if you sell the property, we have the right to make the note due, which makes sense. A bank, when they qualify you to get a loan, they're going to figure out all this stuff about you, and they gave you the loan. And so if you give that loan to somebody else, or if someone else is paying that loan, the bank's going to be like, hey, like look at this. Now, a due on sale is not something a bank has to enforce. They can, or they can choose not to. Um, so it is, but it is something in a creative transaction. It's something to be aware of. It's something to be cautious of, but I don't think it's something to be afraid of either. So there are ways to mitigate the likelihood of a due on sale. I mean, it could just randomly happen to you if you buy a house this way. That could happen. I think most of the time people get a due on sale, there might be reasons. Maybe you missed a payment, maybe your insurance lapsed or changed, and then you got eyes on your transaction. Those could be a reason why it might happen. It could just be random. We've learned there are maybe a couple mortgage companies out there that are maybe more actively looking for this type of transaction than others. But there's also ways, or I wouldn't say around them, but there are ways to fix them. I am not a super expert in them, but I have an idea of a handful of the ways that you can do that. So one of them would be to transfer the deed back to the original owner. So we talked about the deed transferring before, but when you do a creative transaction, the deed transfers to you as the new owner. So that's what might flag a due on sale. So maybe a cure would be to transfer that deed back, and then you continue your transaction as either a lease option where you are making payments that match the underlying mortgage, kind of like a rent to own, but maybe you structure it exactly how that mortgage is. So you still are doing all the things you were doing before. The deed's not in your name. You could move forward with a contract for deed or a land contract, which is where you sell your home, but the deed doesn't transfer until the transaction's complete, meaning you've made all
Mhm.
your payments or you've sold the house. So it's kind of like a good example would be when you buy a car and you get a loan. Your title goes to the bank, and the bank holds your title until you pay it off. That's what a contract for deed or a land contract would be. So those might be options that would mitigate or might be a solution for a due on sale. Also, you could sell the house. Obviously, if you buy the house last week and you get a due on sale today, that's not going to work. But if you bought the house and 5, 6 years from now you got one, an option could be to just sell the house. um, so there are some ways. There are also some resources out there. There's within the subject to community. There's a guy named Caleb Christopher I know deals with these. I think a lot of the good transaction coordinators would also potentially help you, navigate one. I think one misconception that I've heard, we've had a client say this to us when we were working with them, is they thought that if they got a due on sale, it was like we have to figure this out. Like it's due today, and it's not the case. With almost anything within the mortgage world, they have to follow very specific guidelines set out by the federal government. And I don't know the exact time frame, but you will have a time frame to cure or fix a due on sale if you were to get one. So it's not something that I would be overly panicked about, but it is something to definitely be aware of and understand, um, or at least understand who could help you if you were to get one.
No, that's great. And I think the due on sale clause is like the big bad boogeyman of creative finance, and everybody thinks this is for sure going to happen to them. But there's a lot of transactions that are done out there creatively, and it's somewhere around 1 to 2% maybe that this happens on, something like that. That's maybe even a high estimate. So doesn't mean it can't happen, doesn't mean it won't happen, but the likelihood is very low. And especially if you use a good transaction coordinator who sets up everything correctly, make sure the I's are dotted and the T's are crossed, the likelihood of it happening is reduced. Once again, it doesn't mean it won't happen, but at least you're doing your best to keep it from happening.
Yeah. I think Pace has talked about, like, he owns a lot of creative deals,
Mm-hmm.
like 1 in 500, something I heard. I don't know if that came from him or whatever. And I remember him in a video talking about how he, like, very few people he knows that have got one called, it actually like affected, like they were able to fix it. It wasn't like the end of the road for them. You and I know someone here in Utah who let one. He didn't know what he was doing, and he admits this. He has YouTube videos about it. He lost a lot of money, so it's definitely something to be aware of and understand. But yeah.
Yeah. So let's talk about taxes. Are there any potential tax benefits or tax disadvantages from doing a creative finance deal?
Sure. There definitely could be some advantages, and there probably is some disadvantages. I don't know. I feel like there's probably yin and yang in all of it. But so some advantages if you're a seller, especially if you own your house outright and you sell or finance it, you might be able to. I don't know. You're not going to not pay taxes, but you might be able to defer the taxes or keep yourself in a tax bracket, a smaller tax bracket, so you're not paying as much when it comes to, I believe, capital gains tax. So you sell a $500,000 house that you own outright as an investor. Well, you're going to pay capital gains on that. Again, I'm not a tax expert, but you'll pay something. And I know if you're under, I don't know. I think if you're under about like 150, it's a lot less than if you go over that. And so it's either long term or short term capital gains. Again, talk to someone who's a tax person. But so for a seller, it could definitely be an advantage. Um, if you're someone who's investing and buying, there are ways to avoid paying taxes or at least defer taxes doing creative finance. So you might be able to buy a house for a really low down payment that then you can do what's called a cost segregation study. And they do this study and then they can accelerate the depreciation on your home. And basically what that means is you can take a pretty large loss, and I don't want to get too deep into it because there's so much, and honestly, I'm not an expert, but you can write off a lot. And so get a good accountant who will help you do that. But there's some advantages there. I'm trying to think if there are disadvantages. Nothing pops immediately to mind, but I'm sure someone's figured out a way to have it be worse. So
I don't know of any off the top of my head, but I do think there's a ton of advantages from doing creative finance. And one of the deals that I've been a part of specifically, he wanted to sell creatively because he owned the property outright. He had bought it for 80,000. It was now worth more than 350,000. So we agreed on a price of 340, and he would have paid a very large tax bill had he sold it outright to me because he never lived in the home, so it wasn't his primary at any capacity, any point in time. So all of that would have been capital
Yeah.
gains, that difference between the 340 and the 80. And so instead, he only had to pay taxes on the amount of money that he took in and takes in every year. And so I like to explain it like you could potentially find enough tax write-offs to offset 10,000, 20,000, 30,000, 40,000, versus could you find enough tax write-offs to offset 200,000, right? That's a lot more difficult. And so I think that that's one of the main tax advantages of a creative financing strategy, especially like you said, for people who own the property outright.
Yeah. No, I didn't. That's a great way of putting it.
Yeah. So, is there any way to get involved just from a private money standpoint in a creative finance deal?
Sure. Yes. Lots. So many ways. So first and foremost, we talked about wholesalers. How well, I'll talk about wholesalers. The difference between wholesalers and a realtor is a wholesaler actually puts a deal under contract. Well, if you want to put a deal under contract with any sort of meat, you got to put earnest money down. If you're not putting earnest money down, no one's going to take you seriously. So, like for example, in all of our transactions, I don't think we've ever done less than $1,000 of earnest money, up to maybe 5,000. And if you're in a situation where you have no cash or you're just getting started, that might be a huge burden. You can actually borrow down that earnest money. There are lenders out there who will lend earnest money on creative deals. Then another example would be you and I actually bought a house in Ogden, Utah, here a few months ago. That house, our down payment was, I believe, about $43,000, and then it needed some work. We were going to do a co-living, so we rent it by the room, and we needed extra cash for the work, some holding costs because we knew we weren't going to fill those rooms probably the first month or 2 months. So I think we put in 3 months of holding costs, and then a little bit of a buffer, plus paying a wholesaler. So we had all of that tied into that. I think we ended up borrowing around 70K from a private money lender for that down payment. So they came in with 70, so that covered the down payment, the wholesaler, the paying our wholesale fee, all the things, and then he now gets a 12% return annually, which ends up being about 1% per month, and those monthly payments go to him every single month. We're into the deal with no money out of pocket. We're now renting it. We have 4 renters. There's 8 rooms. We're 1 month in. I mean, well, 1 month since we got the rehab done. So we did some rehab on it. Now we're about another month out from when we started renting it. So we have it halfway full. So right now we're at like our break even. But anyway, that's a great example of a way a private money lender could lend on a creative deal. There are other scenarios where a private money lender might do that with something called a double close. So in some states, like I think South Carolina does not allow you to wholesale a deal. I cannot get a deal under contract and then sell the paper. I have to buy the deal. But if I don't want to buy the deal and I want to sell it to somebody else immediately, which is what we do here in Utah a lot, we don't actually buy them. We put the paper under contract, and when we sell it to somebody else, what I have to do in South Carolina, I have to close on the transaction. Well, I may not have what it takes to close. I may not have the 70K, or I may not want to use my own money regardless. So instead, what I can do is I can borrow money from somebody who will give me that money to close the transaction outright. And then I will turn around and immediately sell it to somebody else. And that person will make a small fee for lending that money, even if it's for a few hours or a few minutes for that matter.
Okay, that's helpful. Um, Thinking about creative finance deals in general, do you have a favorite creative finance deal that you've done that you can give us a little bit of an example on? Maybe something that's made a good amount of money or helped a seller out, even if it didn't make a ton of money. Just an example that is maybe one of your favorite deals you've done.
I like easy ones. So deals where they're easy, that's what I like. No, yeah, no, I think honestly every one of them is like somewhat different. And so that's kind of cool. Um, as far as a favorite one though, honestly, I don't know that I have a favorite one. I think I like the fact that they're all different.
Mhm.
Um, I don't know that I have one where we're like we save them from. Well, I mean, honestly, this one, the one I just referred to one in this video. So if you're watching the whole thing, you'll see that. But we closed on a one that we're doing co-living in Ogden, and I do love the fact that like she was very close to foreclosure, and we
Mhm.
were able to stop a foreclosure. Like there's something cool about that to me is that we're not just getting something that is an advantage to us. We bought a house at a 3% interest rate. It's an awesome thing. But we didn't take advantage of someone. We stopped it from going to foreclosure. Her credit is probably already hurt, but it's not going to be hurt like a foreclosure is going to hurt her credit.
Mhm.
Foreclosure is very damaging to your credit. Creative finance saves a lot of people from foreclosure. Um, so I think for me, that kind of stuff is fun because it's not just like, hey, I want to go make money. It's like, hey, I want to make money. I'm also helping people.
Mhm.
And the other cool thing is one of our creative deals that we bought um, that I also like. It was a divorce situation. They're paying, and they got divorced. They moved out. The wife was paying two mortgages or a mortgage and a rental payment. She's in a tight spot, and it's fun to be able to relieve that pressure from that, and just know that like cool, we're helping someone. And on the flip side, we've wholesaled to people who are recently divorced,
Mhm.
and there was no other way they were going to be able to get maybe a bank financing. They had a big chunk of cash come to them, but then their assets were tied up going through a divorce or whatever it was. And so it's been fun to be able to like help people on both ends of that side.
Yeah, I think they're so much fun when you get to help people. And like you said, with the foreclosure situation, if they sold their home traditionally and they were in a pre foreclosure scenario, it's awesome because then they get out from under the pre foreclosure scenario and they don't hit foreclosure. So that's great. But the problem is that the odds of that person who already has bad credit recovering their credit in any sort of near term future is pretty low because they're probably going to move into a rental and that rental is probably not going to report to the credit bureaus. So they're not going to have some sort of recurring, ongoing monthly payment where they're showing that they're kind of back on track. But in a scenario where you take over that person's mortgage who was previously in pre foreclosure, you're getting it caught back up and you're making payments on time. And now this is actually helping their credit because the loan is still in their name. Even though they're not there anymore and even though they don't own the house, that loan is still showing on time payments, or it's now showing on time payments when it wasn't before. And that can be really, really helpful.
Yeah, totally. It's great, great example.
So thinking about the loan staying in the seller's name, how long does it stay in the seller's name in a subject to transaction?
Sure. So in every transaction, it's different. A balloon is where that loan's due. It could be the same as the underlying mortgage. So you could say there's no balloon, or it could be the same as the underlying mortgage. So when the mortgage is paid off, you have to sell it or refinance, or it could be that there's no balloon at all. You can own the house for forever that way. Um, or it could be 5 years or 7 years. The only thing for me, and I know we've talked about some of that, is I get scared when they're really short. And the reason being is when they're really short, it may not allow for the real estate market to correct in a way that's an advantage to you. I mean, if you're paying full retail for a house in 2025 and you have a balloon due in 2027, that is just not very much time for the home to increase in value. And if you didn't put a huge down payment, I mean, maybe you put a massive down payment, like, okay, cool, you're going to be able to refinance. But if you didn't do that, which in a lot of creative finance deals, we're trying to put lower down payments because that's what kind of makes it a deal. You want to make sure that you're able to refinance without having to put in another chunk of money in 2 years or 3 years. So, we see a lot of agents pushing for these 2 and 3 year balloons. And I think that some of that comes from a seller not maybe understanding and being a little bit freaked out, but it actually is a risk to the seller that hey, in 2 years I'm not going to be able to refinance. So then what are we going to do? You're going to foreclose on me? You're going to go through a foreclosure just because I can't do that? So we always try to push. I mean, I think 5 is a bare minimum. I think 7+ is even better. And then again, depending on your down payment, part of creative is getting really good interest rates. So if I'm going to come in and I'm going to put a lot of money down so I can get this 2.5% interest rate, to me that's what I'm paying for. So I want to keep that as long as possible. Some of it is the understanding of the seller too, and understanding their situation. And I think a lot of sellers think you're just going to keep it forever. I mean, even in investor world, 7 to 10 years is pretty normal hold time for a rental. So the truth is, that person will probably sell it long before a 30-year balloon.
Yeah.
Some might hold it forever. I I'm probably that guy who would hold it for 30 years. I don't know, but My point is just that like you can do whatever you want with that. I would err on the side of caution when they're really short. I wouldn't do them. Like I won't do anything under 5 unless I'm the only. There's an exception there. If you're buying a house so far under the actual value,
Yeah.
then it may not be a big deal. But if you're paying retail, yeah, it's not worth it.
So, how can the seller verify that payments are actually being made if the loan is still in their name?
Sure, one of two ways. Most of the time, we set it up with a third party escrow company, and that third party escrow company notifies them every time we make a payment. They'll get a letter in the mail or an email, however they want to set it up. So that's way one. Two is normally when we close on a, let's call it a mirror wrap, we gain access to the mortgage portal so we can get in there and see it. And we let the seller still have their access to their mortgage portal so they can see those payments are being made. And it's something I recommend. If you're selling subject to, if you're selling a mirror wrap, that's like probably your one job, making sure those payments are being made to make sure that your names, your credit's staying good or being built up. And because you're the bank now, you can foreclose if someone's not making those payments. So
So, what happens with utilities and insurance and taxes in these creative deals? Like, does the buyer have to pay those? Do they change over time? What happens?
yeah, the buyer is obligated to pay all those things. I mean, I guess if you were structured it a different way, you could, but in most cases, the buyer's going to pay all of that. The buyer's going to pay the HOA, they're going to pay insurance, they're going to pay taxes. They're living in the house. They should pay all of those things. They own the house now. They should pay all of those things. Taxes are going to change just like they change for everybody. Every year, the counties reassess them. So your taxes could go up or down. I feel like they always go up, but in the last 2 years, most places the taxes have dropped a little bit because houses peaked so high after COVID, and we're seeing a pretty big correction nationwide. And actually, the counties are showing that as well in a lot of places, not everywhere, but in a lot of places. So yes, taxes are on you, insurance on you. Utilities could change too. I mean, obviously they're going to change because that's just how it is. Use is how those pay out. So yeah, I mean, there's going to be stuff there. That's the other thing though to be super careful of is making sure you're paying attention to mortgage changes. And the
Mhm.
biggest thing is if you're paying a mortgage that already takes money into escrow for your taxes or your insurance, you want to make sure that if there's any changes on a monthly payment to you, that you update that with your servicer or you update it with your bank to make sure you're paying the correct amount. One thing I think is criminal that mortgage companies do is if I make a payment to them and they've changed the payment. So let's say they changed it $100 because my taxes went up. If I pay the original amount, they won't accept it at all. They will only accept it if it's an exact amount or more, which is so stupid, but it's what they do. So they won't accept it. You'll get a notification hopefully, but check it. I check it. I try to check ours every month. I probably don't actually check them every month, but we own 5 of these and I try to check them because last year we had someone the taxes went up. She didn't catch it. Luckily the seller caught it and called us and said, "Hey, we need to get a hold of her and make sure we get this updated." We fixed it. It was fine. But after that, I was like, "Oh crap! I need to check this more."
Yeah, that's a good reminder. I probably do too. Um, I should have asked this ahead of time, but is subject to legal?
No, no, I'm just kidding. Yes, it's very, very legal. No, it's legal. I would say it's legal. It's in the Fannie Mae, Freddie Mac. It's in the guidelines. You can do subject to. You can do this. There's nothing illegal about it. I would say like all industries, there are things people do that are super shady. There are things you can do things that are shady and illegal. The subject to in and of itself is not illegal. So doing normal transactions, going through a reputable title company, using a TC to make sure you're doing everything above board is what you should do.
Yeah, and it's even in the HUD form, so definitely legal. It's just a breach of contract on the mortgage documents, and so something to keep in mind. But um, the nice thing is that the mortgage continues to get paid. Everyone benefits, maybe except the bank. So something to
I
keep
don't know.
in.
They get paid. They don't have to foreclose on someone. It
Yeah,
costs money to do that.
yeah, and I think one of the biggest misconceptions is, so you have a mortgage of 2.5%. We've been talking about these low interest rates that you can get for these creative deals. Why wouldn't a loan get called due when it's a 2.5% interest rate, right? Why wouldn't the bank absolutely hate you for that? Well, the interesting thing is that the bank is always borrowing money, and that's what they lend out, right? So when they had an interest rate of 2.5% that they were giving you, that's because they were borrowing money at, 0.5%. So they're making that 2% spread. So now it's the same scenario, right? You're getting a mortgage for 6% and they're borrowing at 4%. So that's the same delta no matter what. So just because they have a 2.5% mortgage rate doesn't mean that they're trying to go out there and find all of them and get it called due, just because that's not how banks work. They're borrowing money just like anybody else is. Kind of
Yeah,
crazy.
and on top of that too, banks are buying and selling mortgages. They make a lot of their money just in the origination fees. So when they're buying and selling, that's where they make a lot of it anyway. The interest rate, I mean, again, interest rate plays into that, but yeah, there's a whole bunch more than just, oh, we'll get more if we have a higher interest rate.
Yeah. Can you sell or exit a property that you bought creatively? I mean, I'm guessing you can, but like, how do you do that?
Yeah, you can sell it just like any other property.
Hmm.
You can list it with an agent and sell it. If you want to just list it and sell it, you can totally do that. If you've closed with an all-inclusive deed of trust, you own the property now. There are, other things that, you can talk about, a lease option or a contract for deed, where you might have to get permission from the seller to sell it at that point. But from a standard mirror wrap or a seller finance deal, if you're just going to sell it, as long as they're getting what is contracted to them, what their agreed upon amount is. I can't go buy a house on seller financing for 500 and turn around and sell it for 200 and not pay the seller the difference, right?
Right.
But as long as they are getting their lien position or they're getting their money out that was agreed upon to begin with, yeah, you can sell that property.
Oh, that's awesome. So, can any old title company do a creative finance transaction?
It depends on how much coaching you want to do to your title company. How about that? So technically, the answer is yes. Any title company could do it. I would definitely recommend finding title companies that are familiar and have done it before. You're going to run into a lot of roadblocks, I would say, if you go with a title company that doesn't do them, either from lack of understanding or pushback from maybe someone who works there, right? You're going to have someone who's worked there forever. It's like, we just don't do them this way, whatever it might be, right? So there's definitely, I would work with someone who's done these transactions, familiar, does them a lot, and that's also going to be safer. Your paperwork's going to be done better. They likely are going to be safer about it themselves, because for them, they want to make sure that they're also covered.
That's helpful. So let's say I'm brand new, I've never done a creative finance transaction before, but I either A, want to start doing them, or B, I have a seller or an agent that I'm in contact with who's interested in doing a creative finance transaction. Where do I turn for help?
Yeah, that's a good question. There's a lot of resources. Some of them could be literally like partnering with us. Like we've helped a handful of people get their first deal this last year. And so that's one way. Go to a meetup, find people who are doing these types of transactions and partner with someone. That's a great way to do it. JV, joint venture, work with someone on this venture. They might make most of the money. Like, hey, if you're going to wholesale it, they might take all the money or a lot of it, depending on how involved or not you are. But your investment is learning at that point, right? You're the one that's new and wanting to learn, and they're going to do most of the stuff, quite frankly. And if they're not doing it, they're going to walk your hand through everything. And that's, I mean, I think that's fair. It's kind of like that's your price. That's what you're learning. Another resource would be a title company. There are title companies that will help you. There's some that probably won't help as much as others. I was lucky. Our first deal, the title company here in Utah, Christina Moser, GT Title, she's great. She helped us a lot. She didn't do it for us, but it was a lot of like, hey, you need this now. Hey, you need that. We need this now. So she kind of helped us do it. I was dumb back then and didn't have a transaction coordinator at all, and that wasn't great. Another resource would be a transaction coordinator. I how much they'll actually do themselves or just coach you through, I don't know, but that's another resource. Obviously, YouTube's full of resources, but I'd be careful with that because not everything just like I guarantee I've said something here, someone's like, that's not 100% accurate. That's fair. Okay. It's probably fair. I think I'm mostly accurate with what I'm saying, but at the same time, stuff changes. Things might be different. So yeah, but there's a lot of resources, a lot of people who are willing to help you. Um, and yeah, title company will help for sure.
So, how can people get in touch with you if they want to do a deal with you?
Yeah, we have a few ways. Obviously, Facebook, Instagram. You can find me Cortland7 on Instagram and just my name on Facebook. The other way would be we have a website called creativesellersolution.com. There's a tab there that talks about like do a joint venture with us or JV with us, or I think it probably just has our email. You can reach out at any time. I mean, we've done that. We go to meetups. Yeah, but social media is probably the easiest way.
Awesome. Well, thanks so much, Cortland, for answering all of our questions on creative finance, subject to mirror wraps, all the fun things. We really, really appreciate it. And hopefully, this provides a significant amount of clarity for anyone who's listening and didn't know that much about creative finance before today.
Yeah, thank you.
Hey there, it's Andrea. If you enjoyed this video, hit subscribe so you never miss another one. Thanks.